Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Proassurance Corporation Annual Report. Proassurance Corporation offers a wide range of insurance and reinsurance services to various industries. The company's specialty property and casualty segment provides professional liability insurance to healthcare providers, attorneys, and medical technology companies. This includes custom alternative risk solutions such as assumed reinsurance, loss portfolio transfers, and captive cell programs. In addition to professional liability insurance, Proassurance also offers workers' compensation insurance products, including guaranteed cost policies, policyholder dividend policies, retrospectively rated policies, and deductible policies. The company's alternative market solutions provide program design, fronting, claims administration, risk management, SPC rental, asset management, and SPC management services to individual companies, agencies, groups, and associations. Proassurance markets its products through independent agencies and brokers, as well as an internal business development team. With a history dating back to 1976, the company has established itself as a leading provider of insurance and reinsurance solutions in the United States. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to increase significantly in the past year. The stock price of Proassurance Corp has increased significantly in the past year due to several factors. One major reason is the company's strong financial performance. Proassurance Corp has consistently reported high profits and revenue growth, which has boosted investor confidence in the company. Additionally, the company's management team has made strategic decisions that have improved its operations and expanded its market share. Another factor contributing to the increase in stock price is the growing demand for professional liability insurance. As healthcare costs continue to rise, medical professionals are seeking more comprehensive coverage, leading to an increased demand for Proassurance Corp's products. The company's ability to adapt to this changing market has allowed it to capitalize on this trend and expand its customer base. Furthermore, Proassurance Corp's commitment to innovation and technology has also contributed to its success. The company has invested heavily in digital platforms and data analytics, enabling it to better serve its customers and improve its underwriting processes. This focus on innovation has not only improved the company's operational efficiency, but also enhanced its competitive edge. Overall, Proassurance Corp's strong financial performance, growing demand for professional liability insurance, and commitment to innovation have all contributed to the significant increase in its stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the insurance industry are multifaceted and influenced by various factors. On the growth side, specialty P&C segment growth, workers' compensation insurance segment growth, and enhanced coverage offerings to fit changing healthcare delivery settings have contributed significantly to revenue expansion. Leveraging technology solutions, expanding product breadth, captive solutions for large insureds, unique customer service focus, and effective claims management have also played a crucial role in driving revenue growth. On the decline side, intense competition from multi-line insurers willing to underprice workers' compensation products has led to a decline in revenue. Consolidation among insurance distributors prioritizing underwriting efficiency and ease of doing business has also contributed to this trend. Decrease in volume of premium written due to proactive actions to improve profitability, ceased participation in Syndicate 1729, changes in carried EBUB estimate, non-renewal of SPCS, and net premiums earned decline have further exacerbated the revenue decline. In addition to these drivers, other factors such as interest rate swaps, foreign currency forward contracts, contingent consideration associated with acquisitions, and actuarial consulting fees have also impacted revenue growth or decline. Overall, a combination of internal and external factors has influenced the revenue trajectory in the insurance industry. The net income of Proassurance experienced a mixed trend between 2024 and 2025. While it decreased by $1,829, or 3.5% overall, there was an increase of $34 million in the same period. This discrepancy can be attributed to various factors, such as contingent consideration associated with the NORCAL acquisition and proposed merger transaction costs. Profit margins also underwent significant changes across different segments. The workers' specialty P&C segment saw a substantial decrease in profit margin from -$20,683 to $10,708, while the segregated portfolio cell segment experienced an increase from $1,955 to $4,173. These fluctuations can be linked to the contingent consideration associated with the NORCAL acquisition and changes in fair value of contingent considerations issued in connection with this acquisition. The reasons behind these changes are multifaceted. The contingent consideration related to the NORCAL acquisition had a significant impact on net income and profit margins. Additionally, proposed merger transaction costs between Proassurance and the doctor's company also contributed to the variations observed. These factors highlight the complexities involved in assessing financial performance across different segments and periods. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the extracted summaries, there are multiple confirmations of this trend. On page 40, it is explicitly stated that the company generates positive operating cash flow. Furthermore, on page 153, the specific amount of $1,123 million in net cash provided by operating activities for the year 2025 reinforces this notion. Additionally, page 168 reiterates that the company is indeed generating positive operating cash flow. These consistent affirmations demonstrate a clear and sustained trend of strong operating performance. The company's debt level and interest expenses have undergone significant changes over the past year. While there are multiple instances of both increases and decreases, a closer examination reveals that the overall trend is one of reduction. In terms of debt level, the total principal debt decreased from $426,476 in 2024 to $421,563 in 2025, representing a decrease of approximately $4,913. Additionally, corporate debt decreased from $81,062 in 2024 to $79,511 in 2025, and interest expense also saw a significant decline. Interest expenses have been steadily decreasing over the past year, with a notable drop of $3,890,989 from 2024 to 2025. This decrease is consistent across multiple instances, including a reduction of $1,504, 6.7%, in two separate reports, and a decrease of $3,666,000 from 2024 to 2025. Overall, the data suggests that the company has made efforts to reduce its debt level and interest expenses over the past year, with a notable decline in both areas. The performance of the company's insurance segments varied across the 3-year period. Specialty P&C was the standout performer, consistently accounting for 77% of total gross premiums written each year. This stability is a testament to its strong market presence and customer loyalty. On the other hand, segregated portfolio cell reinsurance struggled, experiencing a decline in its contribution from 7% in 2023 to 5% in 2025. This downward trend suggests that this segment may be facing challenges in terms of market demand or competition. Workers' compensation insurance, while not as dominant as specialty P&C, maintained a relatively stable performance, contributing around 23% of total gross premiums written each year. Its consistent contribution is a positive sign for the company's ability to serve its customers across different insurance needs. Management's outlook and strategy for Proassurance Corporation are centered around managing uncertainty in loss reserving, accurate valuation and reporting of investments, and risk management. The company acknowledges the uncertainty surrounding its loss reserving process, which includes a significant portion of incurred but not reported reserves. To mitigate this, management emphasizes the importance of transparency and compliance with accounting guidance. In terms of risk management, Proassurance Corporation is exposed to market risks such as interest rate risk, credit risk, and foreign currency risk. The company uses derivatives like interest rate swaps to manage its exposure to variability in cash flows from forecasted interest payments. Additionally, the company maintains capital at Lloyd's, FAL, to support previous underwriting years, with a net increase of approximately $3.1 million in 2025. The company also expects to utilize available tax credit carryforwards generated from investments in tax credit partnerships in future periods. However, management has evaluated the realizability of deferred tax assets related to NOL carryforwards and concluded that it is more likely than not that they will not be realized, resulting in a valuation allowance of $24.8 million as of December 31, 2025. Overall, Proassurance Corporation's strategy appears to focus on managing risk, maintaining capital at Lloyd's, FAL, and accurately valuing and reporting investments. While the company has made efforts to manage its risks and maintain capital, there is no clear indication of specific goals or targets for future performance. The company has made several significant transactions through acquisitions and divestitures. On the acquisition side, Proassurance Corporation is proposing a merger with the Doctors Company, while NORCAL has been acquired by the company. Additionally, PRA Corporate Capital Limited, Innova Ray, and Eastern Ray have also been acquired. In terms of divestitures, the company has sold several properties, including a Birmingham AL property that is subject to a letter of intent for sale. The company has also discontinued its participation in Lloyd's Syndicate's operations due to aviation-related losses. Furthermore, renewal rights related to legal professional liability business have been sold, as well as foreign currency-denominated available-for-sale fixed maturities during the first quarter of 2025. The company has also sold properties from tax credit partnerships and a property in Franklin, TN, to an unrelated third party. These transactions demonstrate the company's efforts to restructure its operations and focus on core business areas. The company's financial history reveals a consistent practice of rewarding shareholders through dividends and share buybacks. Over the years, the company has paid out significant amounts as dividends, with notable instances including $2,701 in 2023. Additionally, the company has also engaged in share buyback programs, purchasing shares in various years, such as -50,488 in 2023. These actions demonstrate a commitment to returning value to shareholders and maintaining a healthy balance sheet. That concludes the financial summary for Proassurance Corporation. Feel free to comment below, and I will be happy to answer them when possible.